Back, everyone. So as promised, today I'll be going over cash covered puts and how I use them to generate weekly and monthly income on cash that I am not using at the moment, as on cash that I just want to have as a kind of liquid cash, right? Okay, so to start, what is an option? We'll start from the very beginning. An option is simply a contract where you will either say that you will buy 100 shares of stock or sell 100 shares of stocks at a certain price. It's very similar to a limit order, but instead of actually executing a limit order, you're selling a contract that you will buy it at that price. So each option controls 100 shares of whatever stock that you choose. So here is an example. I chose Ford because Ford is selling at $8.30 a share. I don't have that much capital in here. I only have about $1,500 in liquid cash. So I couldn't do a higher price stock, otherwise I would have. And I'll get into that in a little bit on why I would have rather chose a stock that I'm more comfortable holding. So an option is just simply a contract that you will either buy or sell 100 shares of a certain stock. So the strategy is a cash covered put. And that's what I've done here with Ford. I have sold an $8 put for $6, so it's 6 cents a stock, and that's times 100. So I've sold it for $6, and the market value of the stock has actually gone down $3. So I've gained $3, as you can see. Okay, does everyone understand that? So I've gained $3 because the value of the contract that I sold is worth $3 now rather than $6. And that's what happens when you sell contracts, when you sell options, when you sell a put, you want the value of the put to become zero. You want it to expire worthless. And that's shown really well in this graph here. So when you sell, so let's say the stock price is sitting right here, okay? We'll just call this $20. Okay, and here's a strike price. This is the price that you'll sell. So on the Ford example, my strike price was $8, okay? Currently, Ford is selling for $8.30 right here. Ford is selling for $8.30 right now. But I've sold a put option at $8. So that is my strike price, okay? So as long as the share price remains above the strike price, then I am in the money. Okay, that's what it's called. I am going to make money on it. So if the share price remains above my strike price, I gather my premium, which was the $6, and that is this gain right here, and the contract expires worthless, and I move on and I sell another cash covered put, and we just keep doing that, and I make $6 a week on my $800 investment, which comes out to over 30% a year, which is pretty cool. So we have to talk about the downsides now. So if the stock price crashes, right, and it goes down below $6 on Ford, from our example, or for this example, strike price is $15. Let's say it goes down to $10, okay? So that's when you do lose money, but that's only after your break-even point. So my break-even point with Ford is $7.94 a share. And how do I calculate that? Well, I sold the contract for $6, and that controls 100 shares, so it's 6 cents a share. So here it is, my break even is $7.94. So if Ford drops below that, I lose money. If Ford drops, as long as Ford doesn't drop below that, I don't lose money. I either break even or I gain. So let's say the stock falls within your break-even point in your strike price. Well, you will probably get assigned. And what does that mean? Getting assigned means that your collateral that you have in your collateral that Robinhood has taken, right here. So the collateral that Robinhood has taken will be used to buy 100 shares of Ford at your strike price. That will mean for me, I will have 100 shares of Ford at $8 a share. So that's $800 that they use in collateral. But what's really cool is that this collateral is actually used in the cash management as well, and it earns 1.8% interest uh, on funds that are held as collateral for my selling my stock options. So I'm not only making the premium on the stock options with this strategy, I'm also still making what I would have made if I didn't sell an option. I'll make the premium plus the interest that Robinhood gives me just for my cash being in the brokerage, right? The 1.8% that I get. That's why I really like this strategy with Robinhood. You can sell put options, and you can also earn interest on the collateral that is held for selling these put options. So you're basically doubling down. One is extremely safe, and the other one has very low risk. And if you do get assigned stock, what you can do is a covered call, and this is called running the wheel. So right now I'm selling cash covered puts. That's how it starts. Let's say I get assigned 100 shares of Ford at $8 a share. Well, I'll be selling covered calls at $8.50 a share. So my price per share was $8, right? And I'll be selling covered calls at $8.50, so I can't lose money on the covered call. So if I get assigned, I'll just start selling covered calls on the shares, and then once the covered calls get executed, my shares will be gone, and I will start selling puts again. And so that's the wheel. It's just a big cycle of selling cash covered puts and covered calls, and I'll talk about cash covered calls whenever I get assigned a stock. And I don't know when that'll be. Might be a couple weeks. We'll see. So look out for that video too in the near future. So that's the options, and I'll just go into here. I'll go into the option chain and just show you guys how to do it. So right now the share price is at $8.30. So if I wanted to do this strategy, I want to sell a put. And so the put that I sold right here, I have a -1. I sold one contract here. This was selling for $6 yesterday, and now it's selling for $3. So I've made $3. So that's all you have to do. You just add wherever you think the share price isn't going to go below. But if it does go below, it's not the end of the world. Just hold on to the shares, and then you can sell calls above the current price. So let's say you got assigned at $8. Well, I'll sell calls for $9. So if Ford ever goes above $9, we can execute the price, and I'll just sell my shares for $9, and that's running the wheel right there. But selling puts, so I sold one right here, and all you do is add it and then sell it, and you immediately get you would get $3 of this, so it's 3 cents a share, and remember an option controls 100 shares, so it's $3. That's your premium. The $3 is this part right here. It's your gain, okay? And the break-even point is the $3 minus the $8 that your strike price, so it's $7.97. That is this area right here. It's the $7.97 to the $8 range, and then anything below this is a loss. But that's a loss that you would have incurred even if you just held 100 shares of Ford. If Ford went to 0 and you had 100 shares, well, you would still get all this loss, but you wouldn't get any of this of selling of this premium, right? You wouldn't get any of this premium, and you wouldn't get this discount either. This is a 3-cent discount that you would get as well, and then you incur the $7.97 loss. But that's if Ford goes bankrupt, which is very unlikely. So what do I do with this? So I made $6 on this trade, okay? I earned the $6 premium, and what I do with this is I simply either hold it as cash or I invest it into my S&P 500 index. And that is a video I did last time. It's the safest equity investment you can make. And well, that's my strategy from now on. It's to sell cash covered puts or covered calls and use the premiums to just buy some more of the S&P 500. And that's what I'll keep doing. So what I plan on doing is having about 3 to 4,000 out, so I can sell like higher price stocks, Stag, Pfizer. These would to sell a cash covered put on these. You basically have to multiply these by 100. So to sell it on Centerpoint here, it would cost me $2,652 in collateral, which I obviously don't have right now. So that's why I chose Ford. I really don't want to hold on to Ford for a long time. They just had a terrible earnings call. So, but I don't think it's going to go below $8. It seems to be supporting above $8, so we'll be fine. But yeah, so I plan to have about $3,000 to $4,000 out of the market and just sitting in cash, earning interest and selling puts. So I'm earning that 1.8% interest from Robinhood, and I'm selling puts and getting a premium on top of it. So it comes out to just a crazy amount of monthly income I'd be getting here with the premiums plus the interest, because Robinhood pays you out monthly in interest. And then with the other 5,000 or so dollars, it'll be going straight into the S&P 500, along with all the premiums and interest that I get from my little wheel strategy over here. So I hope this was interesting. I will show you guys how it works out for me over the next couple weeks with my portfolio updates. And if you guys have any comments or anything, please feel free to leave them below. And I'll see you guys next time. Take care.